Hello everyone, welcome to a short lesson video on the topic Analysis and Communication of Accounting Information, that is ratio analysis for Cambridge A-level accounting. In this video we will solve a past paper question on the preparation of financial statements from given ratios. Before we proceed, please note abbreviations are used in this presentation only due to space constraints. Abbreviations are strictly not allowed in the Cambridge exams. This is May-June 2020 paper variant 3.2. We are given the non-current assets and current assets of WPLC for the year ended 31st December 2019. We are also given the current ratio and gearing ratio for the company. In part A, we have to prepare the summarized equity and liabilities section of the draft statement of financial position at 31st December 2019. Summarized means that you only have to show the main headings, and draft statement of financial position means that the company does not consider it to be the final version. So let's start solving part A. So this is part A, summarized equity and liabilities section. We only need to show the main headings, and the main headings in this section are equity, non-current liabilities, and the current liabilities. And then we have the total equity and liabilities. In the question, we have been given the current ratio as well as the current assets. So it should be easy to find out the current liabilities. So we'll find out the current liabilities first. So we will write working note 1. We know that current ratio is equal to current assets upon current liabilities. And in this case, it is 1.6. Therefore, current liabilities is equal to current assets upon 1.6, and current assets are given to us $224,000. 1.6 in the denominator, that gives us current liabilities of $140,000. So we'll write that in our main answer. We have also been given the figure for total assets. It is $780,000. And we know that in the statement of financial position, total assets is equal to total equity and liabilities. So the total equity and liabilities in our answer will also be $780,000. So we'll write that in our main answer. $780,000 is our total equity and liabilities. Next, let equity be X and non-current liabilities be Y. Therefore, X plus Y plus 140,000 is equal to $780,000. Let's write this in equation form. So this is working note 2. Let equity be X and non-current liabilities be Y. Therefore, X plus Y plus $140,000 of current liabilities is equal to $780,000. Therefore, X plus Y is equal to $780,000 minus $140,000, that is $640,000. We know that the gearing ratio is 12.5%. The formula for gearing ratio is non-current liabilities plus preference share capital upon non-current liabilities plus preference share capital plus ordinary share capital plus reserves, the whole thing into 100. This part is nothing but equity, and there is no preference share capital in this question. We have assumed that non-current liabilities is Y and equity is X. So putting these values in the gearing ratio formula, we get gearing ratio is equal to Y upon X plus Y into 100. As per the question, gearing ratio is 12.5%. And we have already seen that X plus Y is equal to $640,000. So 12.5 is equal to Y upon $640,000 multiplied by 100. Therefore, Y is equal to 12.5 into 640,000 upon 100. Y is equal to $80,000. This means non-current liabilities are $80,000. So non-current liabilities are $80,000. We'll give the reference of working note 2. X plus Y is $640,000. Y is $80,000. So we can find out the value of X, that is equity. So we'll prepare working note 3. Equity plus non-current liabilities is equal to $640,000. Therefore, equity is equal to $640,000 minus non-current liabilities. And we have already found out non-current liabilities is $80,000. Therefore, equity value is $560,000. We'll write that in our main answer and give the reference of working note 3. That completes part A of the question. In the additional information, we have been told that the non-current liability of $80,000 that we found out in part A was a bank loan obtained by the company in 2018. The interest on this bank loan is 5% per annum. Return on capital employed ratio was 22.5%. In part B, we have to calculate the draft profit for the year ended 31st December 2019. So let's solve part B. We'll prepare working note 4. The formula for return on capital employed is profit from operations upon equity plus non-current liabilities multiplied by 100. We just saw that the return on capital employed is 22.5%. We don't know the profit from operations. In part A, we have found out equity is $560,000 and non-current liabilities is $80,000. This whole thing we will multiply by 100. Solving for PFO, PFO is equal to 22.5 into 640,000 divided by 100. That gives us profit from operations of $144,000. So this is part B, draft profit for the year. We'll start with profit from operations, which we have found out in working note 4. It is $144,000. From this, we need to subtract interest. The company has taken a loan of $80,000 and paid interest of 5% per annum. That means the interest is $4,000. Information about taxation has not been provided in the question, so we can directly find out the profit for the year. It is $140,000 profit for the year. This completes part B of the question. Next, we have been provided further additional information. We have been given the opening balances of share capital, share premium, and general reserve. In January 2019, 100,000 ordinary shares were issued at $1.4 per share. On 30th November 2019, a final dividend was paid. The dividend cover for the year was 2.5 times. In December 2019, a bonus issue of 1 share for every 6 held was made. The reserves were maintained in their most flexible form. This means that capital reserves will be used before the revenue reserves to issue bonus shares. On 31st December 2019, retained earnings of $18,000 were transferred to the general reserve. In part C, we have to prepare the draft statement of changes in equity for the year ended 31st December 2019, and the total column is not required. So let us see how to solve part C. Whenever we have to prepare a statement of changes in equity, our first step should be to see how many columns will be required. So we require ordinary share capital column, share premium column, general reserve column, and we also require a retained earnings column. We always start statement of changes in equity with the opening balances. So balances at 1st Jan 2019. They have been provided to us in the question. 200,000, 35,000 share premium, $21,000 of general reserve. We don't have the opening balance for retained earnings, so we will just leave it blank for the time being. It is always better to record the profit for the year next. We have already found out in part B, profit for the year is $140,000. It will be added to the opening balance of retained earnings. In January 2019, 100,000 ordinary shares were issued at $1.4 per share. The company has ordinary shares of $1 face value. That means out of $1.4 of issue price, $1 is the face value and the remaining $0.4 is the share premium. Let us record this in our statement of changes in equity. So we will write issue of shares. 100,000 shares have a face value of $1. So they will have a total face value of $100,000. And those 100,000 shares have a share premium of $0.4 per share. So the total share premium on these shares is $40,000. On 30th November, a final dividend was paid and the dividend cover for the year was 2.5 times. Let us prepare a working note for this. So this is working note 5. We know the formula for dividend cover is profit after interest, tax and preference dividend upon dividend paid. Dividend cover ratio is 2.5. In this question, we don't have tax and preference dividend. We only have interest. So profit after interest we have already found out in part B. It is $140,000. That is the profit for the year. We don't know the dividend paid, so let us call it D. Therefore, D is equal to 140,000 upon 2.5. That is D is equal to $56,000. So $56,000 of final dividend has been paid. So let us write this in our main answer, dividend paid, and we'll give the reference of working note 5. Dividend will always be paid out of retained earnings. So $56,000 of dividend. In the last month of the year, a bonus issue of 1 ordinary share for every 6 held was made. So we need to prepare a working note to find out the number of bonus shares issued. So this is working note 6. Old shares, new shares. For every 6 old shares, 1 new share was issued. At the beginning of the year, the number of shares issued by the company was 200,000. During the year, the company issued further 100,000 shares. So by the time of bonus issue, that is the end of the year, the company had in total 200,000 plus 100,000. That means 300,000 issued shares. If 1 new share is issued for 6 old shares, how many new shares will be issued for 200,000 plus 100,000? That is 300,000 shares. When we cross multiply, the new bonus shares that are issued will be 50,000 and each bonus share will have a face value of $1. So we'll record this in our main answer, bonus issue. We'll give the reference of working note 6. Reserves are to be maintained in the most flexible form. That means first we will use the securities premium reserve. $50,000 will be removed from here and transferred to the ordinary share capital. Ordinary share capital increases by $50,000 after the issue of bonus shares. On the last day of the year, retained earnings of $18,000 were transferred to the general reserve. So let's record this in our main answer. Transferred to general reserve. 18,000 subtracted from retained earnings, 18,000 added to general reserve. There are no other transactions which are to be recorded in the statement of changes in equity, so we can find out the closing balance for each of these columns. At 31st December 2019, the closing balance for ordinary share capital is $350,000. Closing balance for share premium account is $25,000. Closing balance for general reserve is $39,000. We can't find out the closing balance of retained earnings like we have found out the closing balances of the other columns because we don't know the opening balance of retained earnings. But there is another way to find out the closing balance of retained earnings. In working note 3, we had found out that equity is equal to $560,000. We will use this figure to find out the closing balance of retained earnings. So this is working note 7. We know that equity is equal to share capital plus reserves. That is ordinary share capital plus share premium plus general reserve plus retained earnings. Equity at year end is 560,000. Closing balance of ordinary share capital is 350,000. Share premium closing balance is 25,000 and general reserve is 39,000. We don't know the closing balance of retained earnings, so we leave it as RE. Solving for RE, we get RE is equal to $146,000. This is the closing balance of retained earnings. So we will record this here. Closing balance is $146,000. We give the reference of working note 7. Let's prepare a working note to find out the opening balance of retained earnings. This is working note 8. Opening balance plus profit for the year of $140,000 minus $56,000 of dividend minus $18,000 of transfer to general reserve gives you a closing balance of $146,000 for retained earnings. Therefore, opening balance of retained earnings will be $80,000 and we will enter this figure in the statement of changes in equity. So opening balance is $80,000, reference of working note 8. With this, our statement of changes in equity is complete and we have completed part C of the question, which also means that we have completed the entire sum. So that was a past paper question on preparation of financial statements from ratios. We will start a new chapter in the next video.